Welcome to a deep dive into the fascinating world of the Federal Reserve's potential next moves as we approach the year 2024. This journey begins with a look at the recent inflation data, with particular focus on the Core Personal Consumption Expenditures Index, or Core PCE. This is the Federal Reserve's preferred measure of inflation, and its recent trends have sparked intriguing discussions among economists and market watchers. The Core PCE has been hovering close to the Federal Reserve's 2% target, a trend that has led many to speculate that the Fed's hiking cycle may be drawing to a close. If we recall, the last rate hike was in July, and this has led to a growing consensus that the peak in the 10-year Treasury has been reached. The focus now is shifting towards when the Federal Reserve will commence the process of cutting rates. Historical data provides some insights into this. It shows that the first rate cut usually comes relatively quickly after the Federal Reserve halts its hiking. The specific timing and criteria for a rate cut, however, will hinge on the prevailing conditions at the time, with particular emphasis on price stability and full employment. If inflation continues to cool down, the Federal Reserve may find itself needing to cut rates to prevent an active economic slowdown. The market, in anticipation of this, is currently pricing in a rate cut for May 2024. Of course, the situation remains fluid and there's potential for more cuts if a recession materializes. As we can see, the Federal Reserve's decisions in the coming months will significantly impact the economy. Let's delve deeper into the potential consequences. So, what exactly are the conditions that would lead the Federal Reserve to cut rates? The answer to this question is a complex interplay of economic factors, but primarily, the Federal Reserve focuses on two key elements: price stability and full employment. Price stability is the concept that the general level of prices in the economy is not changing significantly. When prices are stable, people and businesses can make sound decisions without worrying about sudden changes in the cost of goods or services. The Federal Reserve uses the Core PCE, their preferred measure of inflation, to gauge price stability. If inflation continues to cool, meaning the increase in prices of goods and services slows down, the Federal Reserve may need to cut rates. The intention behind this move is to avoid actively slowing the economy. On the other hand, full employment is a situation where all available labor resources are being used in the most efficient way possible. This doesn't mean zero unemployment, as there will always be some level of joblessness, with people transitioning between jobs or industries. However, when unemployment rates begin to creep up, it could signal that the economy isn't operating at its full potential. This brings us to the possibility of negative job prints in the coming quarters. Negative job prints are when the economy loses jobs rather than gains them. If such a situation arises, it could be a significant indicator that the economy is not performing well, leading to a potential rate cut. In essence, the Federal Reserve uses these criteria to decide when to cut rates. They monitor inflation and employment figures very closely, ready to make moves to ensure the economy stays on track. It's a delicate balance, ensuring that the economy grows at a steady pace without overheating or cooling too much. The decision to cut rates is not taken lightly, and the potential impact on the economy is substantial. Now let's turn our attention to how the markets have responded. The markets are a sensitive barometer of economic conditions, so how have they reacted to these developments? Let's dive into it. Following the release of the inflation data, the global markets exhibited a ripple effect. Share prices slipped and bond yields jumped, marking the largest increase in U.S. inflation in over a decade. The U.S. Consumer Price Index, a key measure of inflation, rose by 5.4% year over year. This surge in inflation ignited concerns about rising interest rates and their potential impact on the stock market rally. Initially, the yield on U.S. Treasury debt fell. However, a weak Treasury auction led to a spike in the benchmark 10-year note. Stocks on Wall Street, initially reacting positively to the Consumer Price Index data, soon took a downturn. This was mirrored in the MSCI World Equity Index and the Dow Jones Industrial Average, both of which declined. Investors worldwide are now playing the waiting game. They're watching closely to see if the Federal Reserve will take aggressive steps to address the rising inflation. This anticipation is charged with uncertainty and speculation, affecting not just stocks and bonds, but also the dollar index, the euro, and the Japanese yen. The broader economic picture is not all doom and gloom, though. In Asia, the MSCI's broadest index of Asia-Pacific shares outside Japan rose, led by a rise in Hong Kong. However, the South African rand dropped to a 3-month low due to escalating violence. Meanwhile, Brent crude and U.S. crude both rose. Gold, the age-old safe haven in times of uncertainty, remained relatively stable. indicating that investors are still weighing their options. The markets are clearly on edge, closely watching the Fed's next moves. It remains to be seen how this intricate dance between inflation, interest rates, and the economy will play out. So stay tuned as we continue to monitor these developments and their implications for the global economic landscape in the coming months. To wrap things up, let's summarize what we've learned today. We delved into the potential maneuvers of the Federal Reserve, understanding that the current inflation data could signal an end to the hiking cycle. We explored the criteria for a rate cut, focusing on price stability and full employment, and learned that the first rate cut usually comes relatively quickly after the Fed stops hiking. We also examined the market's reactions and future predictions, highlighting that the market is currently pricing in a rate cut in May 2024. Thank you for joining this deep dive into the Federal Reserve's next moves. Remember to subscribe for more insightful content like this. Until next time, keep an eye on the markets and stay informed.